Welcome back everyone to the Audacious Money Witch channel, where we talk about the magic behind the stock market. What's up, fam? You know how sometimes the market feels like it's just doing the most, but your faves are stuck in a serious slump. Well, today we're talking about a snack and drink OG that's finally getting some pre-market glow up. Why has Pepsi stock just popped? I have 4 key points to touch on. The weak dollar plays a part, but is it enough? Doritos and Pepsi are struggling. The shocking truth is Pepsi worth the risk? The valuation no one is talking about. Rockstar energy drinks, $1 billion mistake. Did Pepsi just get its groove back? That's right, PepsiCo stock just pulled a major comeback move in pre-market trading today after dropping some seriously fire earnings that actually beat expectations. And get this, they even updated their full-year outlook. Shares jumped 6% to $143 after the report. Is Pepsi finally getting its groove back after a low-key rough year? Let's spill the tea.
So I'm very excited about where the snacking category is going, the same as the beverage category. So now we're growing share in some of the snack segments. We're growing share with Cheetos. We're growing share in with Doritos. We're growing share in permissible snacks, which is the large segment. So pleased, and we think that sequential improvement will continue over the coming quarter.
Okay, so in Q2, PepsiCo absolutely crushed it. Adjusted earnings per share hit $2.12 on a cool $22.7 billion in revenue. That's a solid beat, since analysts were only expecting $2.03 EPS on a $22.3 billion. They literally said, "We understand the assignment." The weak dollar plays a part, but is it enough? And get this, PepsiCo now thinks their adjusted EPS will only dip by 1.5% for 2025, which is way better than 3% drop they thought before. CEO Raman Leguarta even confirmed our core USD EPS outlook has improved because those foreign exchange headwinds are chilling out thanks to the US dollar getting weaker. And for context, the dollar index, it's down a wild 9% this year. It's worse first half since 1973. A weak dollar basically means PepsiCo's international sales abroad hit harder when converted back to USD. Plus, their global business is thriving, which also juiced up those earnings. Dollar index dropping. But hold up. Before you go all in, PepsiCo stock has been down bad, dropping 11% this year. While they've been losing market shares in the beverage game, Doritos and Pepsi are struggling. The shocking truth. Their revenue has been on a downward spiral for 2 quarters straight, all thanks to weak sales for snacks and drinks in North America. Yeah, even your beloved Doritos and Lay's are feeling the pain. Their beverage segment is losing shares, and even their snack business, which used to be fire, is getting hit by everyone being kind of broke due to the inflation. Plus, people are trying to eat more healthier. And maybe there's a low-key backlash against ultra-processed stuff. In Q1, organic sales for their North America food unit, think Doritos, Lay's, all that good stuff, actually declined 2% from last year, and while beverage sales went up 1%, the actual volume of drinks sold shrank 3%, so people are buying less and paying more. Oof. And to add more spice to this drama, potential tariffs could legit drive up shipping and packaging costs, squeezing their profit margins even more. Back in April, PepsiCo was already bracing for flat earnings in 2025, a total downgrade from expecting mid-single-digit growth.
So most of the value is created in the U.S. However, there's ingredients that we bring from outside markets, things that either cannot be produced in the U.S. or otherwise. So we're vigilant on what happens with tariffs. We've been working on both cost reduction. We've been working on changing some of the sourcing and optimizing our revenue management to mitigate for the impact of tariffs. It is a factor. It's not a massive factor.
Is Pepsi worth the risk? the valuation no one is talking about. PepsiCo shares have tumbled 26% from their high back in May 2024. They're seriously lagging behind Coca-Cola, which is up 10%, and the S&P 500, which is up 18% in the same period. It's giving underperforming. But here's where it gets interesting. The stock's current valuation, sitting at 17 times forward earnings, is about 10% discounted compared to other staple companies. Some analysts are still bullish, saying PepsiCo's intrinsic value is higher than its current price. However, analysts are also low-key stressing that investors won't be patient forever for PepsiCo to right the ship in North America. They want to see leadership show more urgency to unlock value. They're looking for updates on how PepsiCo plans to appeal to value-conscious consumers, level up their innovation, think high-protein trends, and boost efficiency. These discussions are going to be meaningful, important to build confidence that the future won't be like the recent past. Rockstar Energy drinks $1 billion mistake. Oh, and here's some piping hot tea. PepsiCo's Q2 profits took a huge hit from a write-down on Rockstar, the energy drink brand they bought. They posted a wild $1.86 billion impairment charge, with $1.78 billion just for Rockstar. Remember when they shelled out $3.85 billion in 2020 for Rockstar to get into the energy drink game? Well, it's not looking like a W right now. They also took an $80 million hit on B & Cheery, a Chinese snack company they bought around the same time. Despite these massive hits, PepsiCo is still trying to flex, saying their business was resilient last quarter, even with a small drop in volumes. They saw some improvement in organic volume for their North America food business as Q2 went on, thanks to stepping up their game with better value for customers and new product drops. Their North America beverage biz also saw organic volume trends improve, even gaining market shares in sodas thanks to the continued strength of Pepsi. Side note, this is my go-to, just saying. So while North America volumes were down a bit, 1% for food, 2% for drinks, other markets like Latin America and Asia Pacific saw growth. CEO Raman Laguarta is saying they're effectively navigating a tough environment, accelerating net revenue growth compared to last quarter. The bottom line, PepsiCo dropped $1.26 billion in net income for Q2, down from last year, mostly due to that massive Rockstar write-down, but strip out those one-time items, and adjusted earnings were still a beat at $2.12 a share. Looking ahead for 2025, the company is still expecting organic revenue to still pop off a bit, like low single digits. EPS to basically stay flat year over year. In constant currency, no major dips. And for us shareholders, they're expecting to drop about $8.6 billion back to us. That's going to be $7.6 billion in dividends. Hello, passive income. And $1 billion in share buybacks, making our shares more valuable, period. They're still working to fix those supply chain costs from trade drama. They're also leaning into automation and data to boost productivity. The weaker dollar is helping them out big time. So, is PepsiCo about to have its glow-up moment? The numbers are kind of mixed, but there are definitely some positive vibes creeping in, especially with that cash back to shareholders. What do you think? Is PepsiCo a buy or a pass? Let me know in the comments below. Don't forget to like this video and subscribe if you haven't, and hit that notification bell so you don't miss our next deep dive. Peace out. I'm really enjoying this Pepsi, but I don't know if I'm going to be able to sleep tonight.
Follow the consumer, and we're making big, bold steps. 60% of our products already don't have artificial colors in the U.S., and we will continue that journey of transformation. We announced today that Lay's and Tostitos, two of our largest brands in the U.S., will move to zero artificials by the end of the year. That's a big commitment. In the same way, we're starting to launch different platforms in brands that we're less sure of how the consumer will react if we eliminate the colors, and those are Doritos and Cheetos, where we know that our colors are relevant for the taste experience or taste perception. So we will launch sub-segments, in this case, Doritos Naked and Cheetos Naked, a line of no artificials and no colors, which we will see how consumers react. And as always, we have one mantra, which is follow the consumer, be ready with options to satisfy that demand.
Well, I mean, if the consumer was the president and he drank PepsiCo and he called you and he said, listen, I want cane sugar, would you do it?
There is obviously an opportunity for sugar cane. I think some consumers like it. In our case, we have the portfolio. We have sugar, no sugar options. We have corn syrup. We have real sugar. We have choices for the consumer, which at the end, that's what we as a responsible company need to do in the marketplace.